The stock market is melting up, yielding a 40% return over the last 12 months and simultaneously making new all-time highs, something that happened in the late 1990s during the dot-com bubble and in the late 1920s just before the Great Depression, two periods where we know that the uptrend was unsustainable. And as you can see from this chart of the S&P 500 that's been adjusted for inflation, just visually we can tell that the stock market is overextended relative to its longer-term trend in a similar fashion to how overextended right before the four largest market crashes in the last 110 years of market data. But before we can actually draw conclusions from this chart, we need to compare it to a version of the S&P 500 that is not adjusted for inflation. And this is what it looks like. The stock market's return since 1921 is around 65,000%. So in other words, $1,000 invested in 1921 would now be equal to $650,000. But when you look at the stock market's return adjusted for inflation, it's only returned 5,000% over the last 100 years. So you can immediately see the impact that inflation has on stock market returns. It's absolutely massive, especially when you look at it on a longer term horizon. This is where the term stocks only go up comes from. But within this very long-term uptrend, we do see periods of incredible pain for investors. For example, if you had invested $1,000 in March of 2000, it would have been worth $500 10 years later, so an extremely poor performance. The same thing would have been true if you had invested money in August of 1929. Your investment would have been worth half of its original value a decade later. That's where this chart comes in useful. It shows us that over the long run, yes, the S&P 500 goes up more than inflation, but it also shows us that the stock market can decline significantly relative to inflation. Now, as you can see, the S&P 500 adjusted for inflation typically moves up and down within a relatively stable range. And the moments where it tagged the top of the range include 1913, 1929, 1965, and 1999. All four of those moments were extremely poor times to be invested in the stock market because the S&P 500 adjusted for inflation eventually moved back to the lower end of the range, on average leading to a 60% decline in the value of the S&P 500 adjusted for inflation, although in the case of the crash of the 1930s, it was much more than that. Now, while most people will agree with this, that the stock market is overextended on an inflation-adjusted basis, not everybody agrees on what that actually means for the non-inflation adjusted S&P 500. The idea is that just because the S&P 500 is going down on an inflation adjusted basis doesn't mean that the actual S&P 500 index is also necessarily going down. This can happen if inflation in the US begins to run out of control. And we can use Turkey as an extreme example of how this can actually happen. This is the Turkish stock market that's been adjusted for Turkish inflation. And we see that on an inflation adjusted basis, the Turkish stock market has virtually gone nowhere over the last 20 years, providing a 0% return since 2006. Now, when we look at the Turkish stock market that isn't adjusted for inflation, it has yielded over a 2,000% return over that same time horizon. This gap, of course, can be explained by the hyperinflation that Turkey witnessed over the last few years. So seeing this chart, we can understand how high levels of inflation alone can push the stock market higher. Many believe this is exactly why the US stock market is rising so aggressively today, that investors are anticipating a major wave of inflation, possibly even hyperinflation, and that the stock market is melting up in anticipation of that, which would make today's melt up considerably different to the ones from the late 1920s and the late 1990s, because those episodes never saw inflation go out of control. Instead, the stock market eventually melted back down. So can we really expect a hyperinflation melt up today? Well, when we look at a chart of the inflation rate in the United States, we see that it's currently hovering at around 2.5%. For a hyperinflation melt-up to occur on the stock market, we need inflation to be significantly higher than it is today. For example, if we compare the Turkish inflation rate over the last few years, we see it's currently at around 50%. So Turkey is experiencing about 20 times more inflation than the United States, and at the height of its inflation problem, Turkey saw an 84% inflation rate in October of 2022. So our opinion is that the argument for a hyperinflation stock market melt up today doesn't really make much sense. Additionally, when we look at every single time in history where the United States saw a spike in inflation, we actually see that the stock market declined in these instances. That's because higher inflation means higher interest rates, and that typically puts downwards pressure on US stocks. That's exactly what happened in the 1970s. Despite high levels of inflation, the stock market actually saw multiple 30 to 50% declines during this period. If we come back to our chart of the S&P 500 adjusted for inflation, this is what the 1970s look like. This is already a much more plausible scenario today, that if inflation were to pick back up, it would cause interest rates in the United States to rise and pull the stock market lower. But again, for now, there isn't really any signs of inflation picking back up in the US. Just look at this downwards trajectory. The price of wheat is down 10% since October of last year. The price of boneless chicken is down 10%. The price of oil is down 20%. The price of natural gas is down 30%. I think you're starting to get the picture. There are some things that are still going up in price, like homes, but in aggregate, inflation has slowed down considerably. So what happens to stocks if inflation never picks back up? Well, that's where things could actually start to look more like the late 1990s and the late 1920s. These periods of low and stable inflation provided the conditions for the stock market to melt up higher. We also saw something similar in the 1980s, where low inflation led to a stock market melt-up that was eventually followed by Black Monday. In fact, each of these great melt-ups eventually imploded in one way or another. And the reality is that today inflation is heading downwards, with many key components of inflation like oil that are also heading downwards. And this environment is allowing the stock market to melt up higher, just like it did in the 1920s and in the 1990s, not like it did in Turkey or Venezuela. We've been of this view over the last year, and we've helped our clients participate in this bull market the entire way through. Now, as you may have seen from our most recent video, we did turn a little bit more cautious on the stock market in the short term, as we think we could see a pullback towards 5,650 points. But overall, the low inflation environment that's been in place throughout 2024 doesn't look like it's about to kill the stock market just yet. You can check out our most recent closed trades on the homepage of our website. Our trades are yielding fantastic results for our existing clients, making the cost of our membership look completely ridiculous. So what are you waiting for? Sign up to our service.